What's going on, guys? Well, we've got a P2P investing model. Now, just to talk a little bit about the business before we get into all the specifics here. P2P investing is when you go on a platform, which is the facilitator, and they screen and do a bunch of different things to allow you to basically lend money to other people or other businesses. There's all kinds of different facilitators that have all kinds of different types of debt. So don't think there's just one type of P2P investing or P2B investing. Person to business or person to person. Personally, if I had the choice, I would stick to probably investing in other businesses that have some financial records and some kind of a very safe risk rating. Because the thing with investing like this, and it depends on the platform, but typically, you're going to be able to reinvest the interest that gets applied to your account. And you'll do that with probably loan parts, unless you're investing millions of dollars. Then you could probably take your returns per month and just do offerings and not have to worry about buying and selling loan parts. But for the rest of the normal people, you're going to probably be investing. Say you made $100 in the month, you want to buy a loan part for $100 so you can compound your return. That's how you do it. But basically, you got to get out there and do your research to figure out what kind of platform you want to trade on and what kind of debt you want to buy, because there is a real difference. You just don't want to fling your money out there. Now, what I've done is I've built a model, and this is because I was interested to see myself, of what the money looks like if you put an initial starting investment into one of these types of things. Types of investment facilities, and keep reinvesting your returns rather than withdrawing it, and then see what kind of money you can actually make after 5, 10, 15 years. I've built the model to go out 55 years. So there's a bunch of different things you also need to be aware of. And I wrote notes down here. Basically, if I just gloss over it, you're going to have to deal with platform fees. Obviously, the facilitator who's providing a service to you to allow you to invest in these things is going to take a percentage off the top. So whatever, and if you set your interest rate for the borrower, or if you bid on a rate, typically the facilitator platform is going to take a percentage of that. So you need to adjust for that percentage in your projected returns. And this is where you're going to put your projected returns, right here. Now, I've also built a schedule to help you with the weighted average percentage return. So say you invest in a bunch of different loans. You could do, I've done 100 here, but you can keep putting information in down here. And this will not pick it up. This is only going to pick up if you go, let's see. I could probably just make it the whole column. So it's not really subject to the range of the yellow cells, but they're just there to help you see. Yeah. So now you can put information into any of these rows all the way down into infinity, and you'll get a weighted average percentage return. So this is not going to flow anywhere else on this model. It's just for you to get a figure that you can put into here manually. And let's say you invested $10,000 in a loan, and your net rate, so this is obviously, again, this has to be for the purpose of what you're using this to plug into on the front. This has to be the net rate, so you want to take into account any fees associated with the return and take that off the interest rate. So you do that net rate, the loan amount for that loan, then say you got another loan for $5,000 at 12 and another loan for $150,000 at 8%. Well, your net weighted average rate is 8.24. So this is to help you project out what your returns are going to be across your entire portfolio, given different percentages on different amounts of capital. So that's just a little scheduler to help you enter this number. We have our starting investment amount, max years, start date. This is important, a cash drag. So this is obviously assuming you're not going to be fully invested every single day of the year. There's going to be layovers for whatever reason. It might be because you haven't, because every month you got to figure out what loans you want to buy. It could take a couple days to do this. I don't know if there's going to be settlement times. The point is, this rate of return is going to be applied. Your platform is most likely going to apply it on a daily basis based on days in the month. It depends on the terms. There's everybody probably does it differently, but the fairest way is that your annual return on each loan gets a daily rate, and that daily rate accrues interest every day on whatever the rate is, and at the end of the month, however many days you were invested per that rate, that's what your return is. So I put a cash drag of 3 days here. You can see if I put this number up higher, it's going to mean I'm invested less. So our IRR and this total dollar return here is going to go down. Say I put it up to 5. See, that went down $100,000 over 55 years. And the IRR went down to 7%. If I put it at 1, you see that goes up and that goes up. So that is going to play a factor, and that's just the best guess estimator. It's generally going to be, if you want to try to take into account everything and be able to be conservative in your projections of how much money you can actually get returned on a given amount of capital. You need to take that into account. I'm going to put this back up to say 250,000. Alright. You can see if I change my active years, all of this changes automatically, and it shows deposits and withdrawals as well as the starting amount. This is all going to play into a factor when determining the internal rate of return. We'll get into that in a little bit. So basically, the way the model works is you plug all this information in: your starting investment amount, your annual net, your average net rate of return. Max years, you're going to be active in this kind of facility or platform. And then the investment returns, this is always going to be monthly. That's just the model. This is a model for monthly reinvested returns, so that's hard-coded. Visuals, we'll get into that once you learn the other tabs. So we have withdrawals. So this is going to be if you want to take money out of the platform and you want to account for that. You pick the date, and you could have multiple. If you have multiple withdrawals that you plan on doing in the same month, just pick the same month and put it again below, or just put the amount you're withdrawing for that month. If you want to just do one lump, so some amount. Either way, this goes all the way down, and you can keep going. I think I put it down 1,000 rows, but this you could actually keep putting in dates, and this is a drop down and it's got 55 years worth of dates, starting with the start month that you enter on the front tab. So you might want to keep dragging this down so you have the validation, but this goes down forever and it will flow into the monthly returns. So it's withdrawals, money coming out. It's going to reduce the amount of capital that's being compounded, obviously, if you're taking it out. Deposits, same thing, but the opposite. It's going to raise the amount of money that's going to compound. It's assuming you're going to invest this when you deposit it on the platform, and then you could pick the dates, and it goes down the same way. 1,000 rows. You can keep going with that too. Now we have this is your detail tab where you see everything happening on a monthly basis. So you can see your net cash flow in this row is just going to be deposits and withdrawals and the starting amount. So right now it's 250. Actually, we're nixing that row because I put it on the annual. It was just made more sense. So anyway, what you see here is you see your starting capital balance, which is the front tab defined. Any deposits or withdrawals that happen in the month, which is just going to run off of these two schedules, whatever you put into here. And then your daily rate of return, which is just going to be that front tab. Always will be the same. It'll be whatever you put in here. That'll be your daily rate of return throughout the entire this entire investment period. Now, obviously, over time, you're going to be reinvesting the money, and the returns are going to change. So my suggestion is try to best predict, and go a low number so you don't over project, because that's the worst, is when you project you're going to make way more money than you actually are. Just make sure this is always going to be lower than the minimum, or close to what the minimum is that your investments are going to be. Now, if you have the same risk parameters the whole time, over the whole amount of years, then this might not change that much, and it might be really accurate. It just depends. It's going to depend on whatever you put in there. So that's your daily rate. Here's the number of days in the month, and this is just taking the month coming up minus the first. It's taking the first day of the month ahead minus the first day of the month you're in, and then it's also subtracting this cash drag. And that's why for January it's only saying there's 28 days of investment. And there's your investment return. So at 0.0226% daily rate of return, which is annualized, would be your 8.24. You take that rate times the 28 days times your capital basis, which is the balance, and you now have your return. Now, month 2, you can see our capital basis has gone up because we're compounding every month. So we're taking these returns, we're reinvesting it in new loans. Ideally, you'd have all this money pretty decently spread out, because you don't want your risk all in one debt facility. And here's, one of the best practices if you're going to invest in P2P lending is definitely spread your risk out. And then be aware that there will be defaults. It could be, less than 1% of the loans, but if it does default, there are recovery methods. There's default interest that might happen. There's a whole bunch of things, and then there's collections. So you do, and that's if you're with the right facilitator, you can actually make some decent returns even if you have defaulted loans. Now, what I've done with this model is I've said that the impact of default interest, collection fees, late fees, and then actually, something that defaults and just goes away and you never get the money back, you never get the capital repaid, nets to zero. So we're not even going, because it's too complex and too difficult to try to model out in the platform. So we're saying that nets to zero. When you take into account many iterations of people doing this kind of thing. So anyway, you can see the next month 250, only 25 days though, so the return for that month is going to be lower. Next month 28 days, but now look at our balance is up to 253,000 because we've now reinvested this much, so our returns keep going up. Here is the total return on initial capital. And now this will obviously vary if you're going to make deposits and withdrawals. That gets tricky, but this is just this will be accurate as long as you're not making any deposits and withdrawals. Now the total dollar return is accurate no matter what you do. That's just saying the amount of interest you've returned so far. And you can see if I highlight these 1, 2, 3, 5, you got 61.51, and let's see, total dollar. Oh, that's going off a percentage. So that's actually, what the more accurate way is going to be, just to sum up the actual dollar amount instead of going on the percentage. So we'll sum up this and lock that. There we go. So you can see 61.51, and that's at April, and you've got this much total interest returned. Just drag this all the way down. See, this goes all the way over 55 years. But based on your assumptions, it won't show the entire, return amount for 55 years. It just will show what, based on your years active, it will populate these figures. Alright, so monthly, we got that going. So that's the monthly tab is then going to drive all the returns. So then we've got our annual. You can see this only goes down as much as the amount of years you enter on the front tab. 10 years, this is your dollar return that you're getting each year. This is the percentage of that dollar return relative to your initial investment. Again, not including any deposits or withdrawals. This is just your total dollar returned. So you can see 277, that should equal all of these, and it does, 277, 645. Then we've got our total ROI, which again is based on just your initial investment, and our return multiple. And then here's where things get kind of wild, is the IRR. So all we're going to want to show is your initial investment in the platform. So you put in 250, and then any deposits or withdrawals in that time, and then the last, and then when you're actually going to end it, you're going to take all the money out, and that means you take all of the interest, you take all of the deposit capital, deposits you made, and then you take all of the interest earned. So that number, the 532, is taking all of this interest returned, any deposits that were made, because that's going to be separate. And really what you're trying to do is you're going to do this capital balance is what you're getting back. And if we go all the way out here, let's just go to the end. You got 14,699,000. Now the difference of this minus this, 147,000 minus the interest returned. Let's see, this is going to be hard to tie out on the spot. So this is the total compounded interest from the last month, so it's not including this 92. Let's put it over here. Oh. Trying to get to a number that makes sense on the tie out. Let me think about this. You got interest returned. Plus your basis. So, assuming you pay out on the year 55, you're going to get the 92,000 plus the total amount of interest accrued up to that period, including the 250,000. Okay, I know why this is not making sense, because I actually have the front at 10 years. So let me. So to get to this 532,000 figure, let's go to year 10. And it'll be the last, it should be the last month of the year 10. Okay, yeah, this makes sense. So you've got your 204, well, let's see, total dollar returns, you've got 242,000, so you've got to return, you're going to take all that money out. You're going to take out the 250,000 that you initially put in. There's the 492. You're also going to get the interest from 5, let's see. It's 532. What are we doing here? This should be the front plus all of the deposits plus the interest. Let me see here. So this is taking all your interest. So you're going to withdraw this amount. Which is really this. Okay, so it's going to be your total interest, $242,000, and that includes the interest for that period. Oh, hold on. I got to go to the end of year 10. Okay, here we are at the end of year 10. So the capital balance, you've already taken into account withdrawals. So that's 529. Now what's the difference of this and that? It's 3,346, and that's what the interest is for that day. Perfect. All right, that makes sense. So yeah, that's what it should be. Is it should be this running capital balance. So this is the same, the balance that you're invested in at the moment. So you basically, this says you're going to sell all of those loan parts or get out of them all at the end of the month. You're also gonna, but you're gonna get interest for this month. So your actual withdrawing $532,000. And now this already takes into effect any withdrawals that you've made, like this $5,000 up here. So really, you're getting, you've already taken into account taking this down off of the balance, but you're still going to get back your initial plus all the interest that has been earned. Which is what this should be, is basically all of the interest earned. Now we should be able to tie it back this way too. If we go this plus the 250,000, let's see, that's total interest plus your 250,000, and then you're going to subtract anything here, but then add in deposits. I think that makes sense. 517. Let's see, you've got $277,000 of interest earned. Let's just write it out here. You've got $250,000, and let's just make sure the logic does work, of your initial amount invested. So these two are 527. And the amount we're saying you're going to get when you take this withdrawal is 5,000. Okay, so I'm missing a $5,000 is, where am I missing that at? The interest wouldn't count for it. The 250. Oh, here. So 250 plus the deposit. Perfect. And then this number simply takes the sum. So you get all your deposits and all your interest returned. Now see if we put another deposit here of 5,000. Let's say we put this deposit on May 2026. So now what, and this will help really make it clear for you. So now I've put in $5,000 on April 26th. So now on the date, and let's make sure this includes it. So let me just put this out 25 years. So the day I take all the money out of the account, I should be able to get back this 5,000, this 5,000, this 250,000, So that totals to 260,000 plus all the interest that I have earned, and that should be the value of the account. And unless any other fees that might be there, but it's hard to account for that. So based on that, our number here, and wow, look at that, 1.6 million just by adding another 5,000 in 2026. Now, does that make sense? Hold on a second. Let's see. Oh, sorry. That 5,000 on 2026 is only about 10 years in the future. So yeah, that does make sense because you're basically adding up 5,000 in year 9, and then you've got another 16 years where this 5,000 is now being compounded. And you can see in our monthly here, we now have to go over to year, the year 25. And the reason why I'm doing this is just because, it's prudent. Anybody who gets this model would do this anyway to figure it out. So I'm just showing you how you would, this easier for me to just do it in front of you, so you can follow along when you're doing this in the future if you get this model. Okay, so 1.3 plus, and we're trying to get to 1.638. So we'll go plus the 1.3 is your total interest you've earned on the account, plus the amount of money you've actually put in, which is 250, plus this deposit and this deposit. 1633, and oh, what do we have there? Where are we out? Year 25. We're out 5,000 now. What 5,000 did I miss now? C3 and 24. 5 and 5. Withdrawals 5, 5 and 5. Okay, I've got it. Right, and that this is what happened when you do one of these models for too long at one time, is you just get messed up. Here's what the 1.638 is doing. It's taking the net effect. So obviously if you've already withdrawn 15,000, you're not going to be able to re-withdraw that. So the net amount, if you take that 15,000 minus the 10,000, the net amount is 5,000 plus the interest plus the front. 1,628,000. Now if we do that plus, yes, 1,638,526. So that makes sense. Because I was trying to think in my head, I got too far up and I wasn't thinking about the effect of the withdrawals. Well, if you withdraw some money, that's going to come out of the total money you're going to be able to get on when you're looking at just the deposit ledger and not the interest. Okay, so hopefully that helps you understand the logic that's going on here. And whatever you do, this will auto populate, and we just did basically the logic check to make sure this works, and it is working. And we can see our IRR of 7.7% is assuming, even though you're getting that interest return to your trading account, you're actually not getting it back to the bank. So it's not, we're not saying that it's the cash flow for the internal rate of return. You're not actually getting the cash flow until you take it, withdraw it. So the schedule would be, put 250 in, then here we put another 5,000 in, another 5,000 in. And then we took 5,000 out here, took 5,000 out here, and then we close the account. we closed it at 1.6 million, so that's the IRR of 7%, 7.7%. So that's how I've decided to approach investing in a P2P lender, building a model for it, and that's about as far as I can go without, basically just looking at your account and doing every transaction by day in interest and just manually doing it. But obviously, for the purpose of projections, you can't do that. You want to, test various assumptions, and this is your sensitivities: your interest rate return, your initial investment, the amount of years, the start date, the cash drag, and then any withdrawals or deposits that happen with this. And based on that, you want to get some idea of what the dollar return looks like. I put together a visual here. Let's just do it. Looks nice and clean at 55 years. So here you could see, without any other deposits or withdrawals, let's just say it's, let's do a $5,000 amount, because that's more along the lines of what the average person would have. You put $5,000 in. You reinvest all those returns every month, so your monthly compounding, your return, your annual rate of return. And you can see after, after 55 years, you are getting a 421% return on your initial capital. And all you're requiring is an 8.24% net return with a 3-day cash drag. So as long as you just keep getting that 8% every year, it turns into the 420%. That's the power of compounding, and that's where you don't actually need insane monthly return or annual returns to grow money over time. Now you have to have some kind of a horizon here. If we look at, let's just look at 15 years. That's a little bit closer for you guys to get an idea of. If you do it for 15 years, you're now getting, you basically double, you're getting 21.8% annual return on your initial capital. And that's getting you about $1,000 a year. And remember, you're only investing $5,000 initially, and this is your rate of return. So we've got the chart, we've got your schedule, we've got your monthly, we've got your annual, your weighted average helper, and on the front, just to give you an overview. Put this up, let's just start at 100,000. Total return. Now we could also do total annualized dollar amount and total annualized ROI. Now that number kind of gives you, if you take the overall cash flows and then annualize it, well, the dollar amount's easy. Just say, well, I've made this much interest and it took me this many years, so you make $13,000 a year. Say you had 500,000, make $67,000 a year. And this is probably the most important thing. This is where people want to get to, is how much do I got to put up? And then you might want to say, well, after 5 years, I actually want to withdraw a certain amount every year, but I still want to compound it monthly. You could put that withdrawal schedule here, and that would affect the dollar rate returns. But let's just say you put in 500,000. How much am I going to make every year? Well, according to all of this, about $67,000, and that turns into annualized. You take the dollar amount just divided by your initial investment, about 13% a year. And that's going to be higher than your rate, obviously, because this is going to be higher than your 8.2 because you're reinvesting. So your basis is staying the same at whatever you deposited, but your amount that you're actually gaining interest on starts going up, and that means your return on investment is going to go up relative to the initial capital that you use to start this endeavor. Put it back down to say 125,000, 16,000 a year. Now most people, let's say you want to live off of say $25,000, you'd probably have to get this up to 250. Not quite 200,000. Say about $200,000 at 8.2% average net return. You're looking at about $27,000 a year, given these cash drags. Now let's say your cash drag is only 2 days a month, and you're actually, if you look at the course of the year, you are invested 100% of your capital in every single day of the month except for 2 days of the month, and you're giving yourself those 2 days for whatever, you know, dynamics or logistics it takes to invest on the platform. Well, that gets you up to 28. If you say 1 day, you're up to 30,000 a year. If say go 4, say it takes longer, whatever, you're trying to be more conservative, now you're down to 25,000 a year. So this is a pretty cool tool, and I'm actually happy because I wanted to see this. I'm actually going to use this myself. And you really can play with these sensitivities, especially the rate of return, your starting investment, and your cash drag, to see what your annualized money looks like. Alright, well I think that's it. I've been thinking about doing this kind of model for a while. So I'm going to sell it at a mid-level price, only $45, and I believe this is probably one of the best functional or useful things or tools that I've done that pretty much anybody can use and play with. Now it's probably going to be, I mean, the most value is going to be for people who are doing over 100,000, because you want to make sure you're getting the cash flows right, and that's what Excel and formula logic is for, is to try to avoid human errors and take into account everything. Then we got the nice visual there, the withdrawal deposit logic, and the weighted average helper is just little tools. Alright, I think that's as much as I could think of putting in here. And if you have any suggestions on how to make this better, I'll definitely take it. If you do want to purchase this, obviously it's the mid-level price, which is $45, one-time fee. And you can get it through my blog at smarthelping.com. The link will be in the description box below.